Stan Druckenmiller reveals sobering insights into America's dystopian future. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over the shocking data. And I want to remind everyone to stay to the end of this video. If you watch step number 3, you're going to see why this video might be banned by YouTube. So make sure you watch the entire thing today, because I don't know how much longer it's going to be on the platform. We know the level of unemployment skyrocketed since the cerveza sickness, and at the same time, somehow, incomes have actually increased because of the stimmy checks. The Fed's balance sheet at the same time, or the Fed's BS, whichever you prefer, has gone through the roof. Also, corporate debt, including junk debt, the lowest rated corporate bonds, prices have been going up, yields have been going down. The complete opposite of what typically happens during a recession. Usually the corporations will reduce the amount of debt on their balance sheet. They want to play it safe. This time, they increased the amount of debt on their balance sheet, throwing caution to the wind, just like they would if the economy was booming. And right about now, I know a lot of you are probably saying to yourself, yeah, George, I get it. I've been watching your videos. I've been watching the news. I don't like it, but I realize unemployment has gone up, income has gone up, the Fed's balance sheet has gone parabolic, so has corporate debt. This isn't anything shocking to me. But what you don't understand is the actual numbers behind what is going on. So sit down, buckle up, pour yourself that stiff drink. Editor, let's go right to the internet. First, let's take a look at how much unemployment has actually gone up. We go to shadow stats because we see the true unemployment rate when you count all of the people who are not working compared to the government's statistics of U3 and U6. So even when you look at U3 and U6, the spike we had for the cerveza sickness, or in 2020, was much higher than the GFC. And if the government wouldn't have come in and spent $5 trillion in stimulus and deficit spending, which we'll have to pay for later, not necessarily with taxes, although that's definitely a reality, but more so with the distortions in the economy, the malinvestment and misallocation of resources. More on that in a moment. But when you look at the shadow stats numbers, it's far higher than it was during the GFC. And this is, again, when you include the amount of people not working other than the retirees. This would include people who are recently unemployed, people who haven't looked for work in 4 weeks, and people who haven't looked for work in over a year, but are still within the normal working age. And I want to show you that I'm not cherry picking data from shadow stats. So we go to thebalance.com, and this article is titled, "What is the Real Unemployment Rate?" And they go through the difference between U3 and U6. And even this website, which would be maybe more mainstream, shows the U6 number spiking much higher than it was during the GFC. So the next question becomes, how much did personal incomes actually go up? We've heard everywhere that they went up because of the stimmy checks, but by how much? And this is where the data gets utterly astonishing. When I was researching this, I literally almost fell out of my office chair I'm sitting in right now. So, and by the way, this isn't from some libertarian website. This is from the BEA, so the Bureau of Economic Analysis. This is straight from the government. So personal income by state in the second quarter of 2020, and this is when the stimulus was in full effect. So that means increased unemployment benefits and stimmy checks going to those individuals who are making, I believe it was under $75,000. So for Q2 of 2020, state personal income increased by 34.2%. just from Q1. And they say this is an acceleration from Q1, where income grew by 4.1%. Because right at the tail end of Q1 is when we started to see the increase in transfer payments. It goes on to say personal income increased in every state and the District of Columbia, ranging from 15.3% in the District of Columbia to 76.3% in Massachusetts. Incomes went up by 76% in Massachusetts just in Q2 of 2020. Wow, unemployment levels were higher than they were in the GFC and right around where they were during the Great Depression. That's what I'm referring to when I talk about a government put for the stock market, asset prices, and the entire economy. But let's hear it right from the horse's mouth. According to the Bureau of Economic Analysis, increases in personal current transfer receipts more than offset decreases in earnings and in property income. The increase in transfer receipts includes new government relief payments provided by the Surveillance Sickness Relief, in other words, the CARES Act of 2020. And just so you can see how dramatically the real economy is being affected right now by government spending and stimulus, let's look at the personal incomes from Q3, so the quarter after Q2, where incomes across the United States went up by an average of 34+%. In Q3, state personal income actually decreased by 10%. And you most likely know why, but let's hear it from the Bureau of Economic Analysis. The decreases in personal current transfer receipts and property incomes more than offset the increase in earnings. Reduced government relief payments provided under the Surveillance Sickness Aid Relief CARES Act of 2020 were the leading contributor to the decrease in personal current transfer payments. In other words, the personal income in the United States is fluctuating by 30%, the next quarter down by 10%, and this is all a result of government central planning. How can we expect to have a fundamentally sound recovery or any recovery whatsoever in the private sector, in the real economy, with this type of micromanagement? This is the complete opposite of free market capitalism, and I can assure you it doesn't end well. So that's what's happening in the real economy. Let's check out what's happening in the financial economy. This is a chart of the U.S. Treasuries owned by the Fed. The main thing I want to point out is prior to the GFC, they owned about $800 billion worth of treasuries. At the beginning of the repo spike, repo madness, remember that was back in September of 2019, that's where the Fed stopped quantitative tightening and started quantitative easing again, although that was not QE, according to Jerome Powell. So let's look at the difference of the amount of treasuries on the Fed's balance sheet prior to the GFC compared to where it was just before repo madness in September of 2019. Again, we start at 800 billion. We go to roughly 2 trillion. So in the last 10 years, and Stan Druckenmiller points this out in his interview, we'll be getting to in just a moment, the Fed bought 1.2 trillion in treasuries. In other words, they did 1.2 trillion on net in quantitative easing. That was over the last 10 years. That was through all of Ben Bernanke and Janet Yellen being in charge at the Fed. But just in little over a year from repo madness to call it the end of 2020, the treasuries on the Fed's balance sheet went from 2 billion approximately all the way up to 4.7 plus trillion. So that's an addition of $2.7 trillion worth of treasuries, more than double the amount of quantitative easing they did over the last 10 years, they did in a little over a year. And an even more shocking statistic is they increased the treasuries on their balance sheet more just in 3 months, from March to call it May of 2020 than they did in the entire previous 10 years. Now let's move on to the corporate profligacy I was referring to earlier on the whiteboard. So during the GFC, corporate debt went down by roughly $6 billion. But after the repo spike, where the corporations knew the Fed had their back and they could go to the casino and they would come out a winner every single time, their balance sheets, including the cerveza sickness, went from 10 trillion up to almost 11 trillion. So an increase of $1 trillion compared to a decrease of about 600 billion. To put that in terms everybody can understand, that's like your family going through a difficult economic period, and instead of paying down your credit cards, you're maxing them out. So we've gone over some data that I think you would admit is definitely shocking. Let's see how it plays out in the real economy and in the financial economy. We've got the government and everybody's, second favorite. I think Moody the millennial is everyone's favorite, but their second favorite is your drunk, insolvent Uncle Sam. He is making it rain with all of the stimmy checks, the unemployment benefits, the transfer payments that resulted in the average American's income going up by 34+% in Q2 of 2020. So all of that newly printed money that the Fed is monetizing going into the real economy. Before this happened, before the cerveza sickness, when we had a more normal economy, we had the producers on the left. This is the simple economy I always use, where this individual is growing cows, wheat, cotton, and then we've got the domestic services, which are the majority of the economy, and that would be represented by everyone's favorite, Moody the millennial. Now, where are we getting all of the stuff we consume? Because the producers are only producing a fraction of what's consumed by the American public. Most of that stuff is coming from, we'll call it country XYZ, or better known as China. But it's really this entire region, Germany, other parts of the world. Then in 2020, the United States went into lockdown mode. And I'm not going to debate whether that was good or bad from a health standpoint, but we all have to admit that crushed the economy. That created massive unemployment, and we had even less production than we had before. So prior to the cerveza sickness, the producers were growing the cows, wheat, and cotton. Now they're just sitting at home collecting their unemployment benefits. While at the same time, Moody the millennial is opening up a Robinhood account and taking their stimulus check and going into the stock market and gambling on whatever is hot in a Reddit forum or on Instagram or TikTok. And when you look at how much personal incomes increased in 2020, while at the same time unemployment going parabolic, is it any wonder that food prices increased dramatically and we had so much speculative activity, I would call it a mania, in the stock market? Which brings us right over to the financial economy. While your drunk, insolvent Sam was making it rain in the real economy, the Fed was doing quantitative easing like we have never seen before. Unprecedented levels of quantitative easing. As much in 3 months as they did in the last 10 years with Bernanke and Janet Yellen. Really staggering amounts. So they print up all of these bank reserves, funny money. That's why I've got the dollar signs in red. Those go to the commercial banking system. They create loans from the funny money, which basically go to the hedge funds, financial institutions. So they take the newly created dollars, go into the stock market, or the financial markets, I should say. They buy stocks, bonds, real estate, or mortgage-backed securities, which makes the real estate market go sky high because a lot of the people in the real economy are buying real estate as well with those super low mortgage rates. So you have the Fed creating these bank reserves, funny money, and the banking system, the hedge funds, the financial institutions, and the retail investor taking all of those newly created dollars and going into assets. That's why we see this mania. That's why we see the everything bubble. That's why we see stocks, bonds, and real estate at all-time highs. So you may be saying to yourself right now, okay, George, I get it, but what's the problem? Incomes are rising, asset prices are going through the roof, we're all getting rich. Not really. Let's do a comparison. What's the difference between Germany and Zimbabwe? If it were just a matter of currency units, Zimbabwe or Venezuela would be far richer than Germany. They have way more currency units, trillions and quadrillions more currency units than they have in Germany. Of course, the difference is the amount of stuff they produce, the amount of goods and services a society produces efficiently. So I would ask you, if we continue on this path, is our society going to produce more or less goods and services in the future? If you answered less goods and services, that means we're on a path to becoming poorer as a nation and a society. Another way to think about it, let's use Sam Corp. Now, that's not Sam's Club. That's your drunk, insolvent Uncle Sam's corporation. And S Corp doesn't produce anything except a cryptocurrency. We'll call it the Sam coin. So S Corp uses the Sam coin to buy supplies, to pay their rent, to pay their utilities. So all of the Sam coins go out and they get stuff for those coins. But again, they're not producing any goods and services. They have 3 employees, which just happen to be Moody's. So they have 3, or is that Moody? I don't know what the plural of Moody is. So we'll call it Moody cubed right here. And Moody 1 is in charge of social justice. They are the VP of social justice. Moody 2 is the VP of safety. Moody 3 is the VP of inclusion and feelings. Wow, definitely important. Now, this may be good and this may make everyone feel warm and fuzzy inside with rainbows and unicorns, but they're not producing any widgets. They're not making society richer. And at some point in time, all of these vendors that are giving them the stuff are going to look at their Sam coin and say, wait a minute, if Sam Corp isn't producing any stuff, I can't use these Sam coins to buy anything in the future. So I'm going to stop accepting Sam coins for payment. Well, that's the only thing that Sam Corporation has. So if they can't use the Sam coins to buy anything, they're bankrupt, they're bust, they're insolvent. And it's the exact same thing with the US economy if we continue down this path. And if you don't believe me, let's look at some more data. Editor, throw up the chart. This shows us the amount of M2 money supply compared with GDP. So if the line is going up, that means the amount of money creation is going up at a faster pace than nominal GDP. But let's think this through. After analyzing this chart thoroughly, it becomes apparent that economic output in the United States has gone down dramatically. And we've tried to fill the void with just creating more and more currency units. In other words, we're getting a lot closer to Zimbabwe and a lot further away from Germany. Step number 2, capitalism is dead. Stan Druckenmiller talks about this as well as a lot of those mind-blowing stats we went over in step number 1 in a recent interview that was extremely powerful. Editor, let's cut right to the clip.
How would you characterize the state of American capitalism? Are you worried about, again, kind of the American-style, Western-style future of capitalism?
Well, the reason I'm worried is we haven't really engaged in capitalism for quite some time. The central bank has bastardized probably the most important price in the world, which is the cost of money, particularly at the long end. We have crony capitalism, as you know. Just to frame things a little, the recession we had last year, or whatever you want to call it, the economic downturn, was 5x the average recession since World War II, but it did it in 25% of the time. More bizarrely, during the year, while 11 million people more were unemployed, we had the largest increase in personal income in 20 years during an economic downturn that's occurred. And of course, as you know, that's because of the massive policy response we got. The CARES Act added trillions of dollars in fiscal stimulus. How big was it? In 3 months, we increased the deficit more than if you took the last 5 recessions combined. And those were big ones. That was 73, 75, the 82 recession, the early 90s, the dot-com bust, and then, of course, the great financial crisis. If you added the increase in the deficit in all those 5 periods and combined them, we increased the deficit in the U.S. more in 3 months in 2020 than we did in that cumulative total. The Fed, in 6 weeks, bought more treasuries than they did in 10 years under Bernanke and Yellen, when people like me were screaming about how excessive QE was during that period. Corporate borrowing, which almost always goes down in a recession as corporations re-liquefy, and had already gone from 6 trillion to 10 trillion because of free money going into the period, actually went up $400 billion. Just put that in perspective, it went down 500 billion during the great financial crisis. So we had this massive increase in liquidity, this massive increase in stimulus, but this is sort of the background, and obviously all this stimulus has flowed into financial markets, into commodities, into financial interests. So it's sort of a bizarre background.
Those are truly some incredible insights, but I want to remind everyone to make sure you stay tuned to step number 3, because we're going to go over some very controversial material. Hopefully, YouTube won't ban this video, but we shall see. So I want to focus on what Stan was talking about at the beginning of the clip, where he said we don't practice capitalism anymore. And he specifically referenced the Fed manipulating interest rates. And I think very few people understand how this works. We think the Fed just manages interest rates, and from that we get the capitalist system we have. But Stan correctly points out that this has nothing to do with free market capitalism. In fact, it's the opposite of free market capitalism. Here's what he's talking about. We have to remember that money is lent into existence, and the interest rate is the cost or the price of money, or better said, currency. I know Mike Maloney's watching this video. He's going to correct me on that for sure. So Mike, I apologize. The interest rate is the cost or the price of currency, and currency is lent into existence. Well, currency, in other words, capital, is an input cost for corporations and businesses that produce goods and services. Therefore, it's a true statement that the price of currency is the price of stuff. Not that the price of currency equals the price of stuff, but it impacts every single good and service we buy daily. So what happens is the Fed comes in with quantitative easing, which, as Stan points out, has gone parabolic since the repo spike in 2019, more specifically during that 3-month time frame during the cerveza sickness. So they're trying to manhandle the yield curve. They're trying to bring interest rates down, especially at the long end, to ease the economic impact on the real economy. So let's just say, as an example, we've got a simple yield curve here. We go from 1 month out to 30 years. On the left, we go from 0% up to 2%. Currently, rates are barely above 0% until we get out to 1 year. Even the 10-year is barely above 1%. But in a free market without the Fed manipulating interest rates, let's just say they would start at 2.5% and go all the way up to 7%. Well, if this is your input cost for a lot of the goods and services, it's going to directly impact the price that you pay for things like housing, for autos, when you go to Home Depot or Walmart. And it could impact the price by forcing it up. It could also impact the price artificially by moving it down. It distorts everything. So you could be saying to yourself, okay, George, I get it, but what's the big deal? So what? I go down to the store, and instead of paying 50 cents for a can of Coke, I should be paying 55 cents, or I should be paying 45 cents. Who cares? I'd like to point out the fact one of the main reasons communist Russia failed and collapsed was because they didn't have correct price signals. They didn't have any prices at all, for that matter. So they couldn't judge how to allocate resources. We're getting closer and closer to that the more the Fed does quantitative easing and manipulates the price of money or currency itself. Another great example of that is the price of timber. I had a great interview with my good buddy, the uneducated economist, who really has his finger on the pulse of materials that go into housing. And he talked about how the price of lumber has gone up 4x. It's quadrupled since the cerveza sickness because of all the central planning. This is why Stan Druckenmiller says we no longer have free market capitalism. We have centrally planned crony capitalism. And I would add, it's centrally planned crony capitalism trying to micromanage an ever-growing welfare state. Step number 3. Now it's time to connect the dots. Forewarned, this content is going to get a little controversial. So if you're someone that gets triggered easily, you should go ahead and turn off the video right now. But for the rest of you who aren't snowflakes, let's say, we're going to walk through a thought experiment. And this is something that I've been debating and I've been going back and forth with. I've been trying to think through for quite some time. And it's something that nobody is talking about. No one out there that I've seen has been putting the pieces of the puzzle together like this. But I've got to give all the credit in the world to my favorite economist and favorite thinker of all time, Dr. Thomas Sowell. We all know, looking at the United States and going through step 1 and step 2, that there are a lot fewer jobs. That's kind of a no-brainer when you lock down an economy and unemployment goes up to Great Depression levels. You're going to have fewer jobs available. Also, the skill set is going down, I would argue. There are fewer skills in the general population. Why is this? Because instead of going out there and creating goods and services, becoming more productive and learning how to become more efficient, we have told people to stay at home and we'll just send you checks. You don't have to produce anymore. All you have to do is get up off the couch, go to the mailbox and collect your check from the government. Because of the welfare, or call it unemployment benefits, and the stimmy checks, we have distorted the incentives. So why would you be incentivized to go out there and learn skills when you could take your $600 stimmy check and turn it into $12,000 by going into the stock market and gambling? It's what everyone is saying on social media right now, especially on TikTok. Editor, let's throw up the clip and remind everyone of how easy it is.
How to turn your $600 stimmy into $13,000. Stocks to invest in 2021. The first one is Blink, BLNK, the gas station of electric vehicles. Last year, their stock price was just $1.89, and today it sits at $42.75. That's a 2,161% growth. The next one is Square, SQ. Last year, their stock price was $63, and today it stands at $217. That's a 240% growth so far. Lastly, we have Tesla, TSLA. Last year, their stock price, and this is taking into account the stock split, was at $86.05. And today it stands at $705.67. That's an over 700% return. Investing in any one of these three companies will bring you large returns. For more fun and finance and daily live trading, join me for free on my Discord.
And of course, the unintended consequences of this cocktail of central planning and increasing the welfare state is the wealth has been concentrated at the upper end of the economic totem pole. So all the wealth is accruing to those individuals who were rich to begin with, and the people that get screwed in the long run are the poor and middle class. But I want to point out there's a group in the United States that statistically has been challenged for many decades. In fact, we hear about it in the news constantly. But the reason for the challenges might be a little different than what we hear in the news, at least according to Dr. Thomas Sowell. Let's cut to the clip.
That's kind of a harsh generality, isn't it? Because a lot of people who really are philanthropically minded are in favor of the kind of thing that is generally understood as charitable intercession, isn't it?
Yes, there are people who are professional politicians who simply look at the bottom line and where the votes go. There are other people who sincerely believe that if they will hand out things here and there, that this will in fact benefit people. Again, looking at
your point is it doesn't.
It doesn't. I haven't been able to find. I haven't been able to find a single country in the world where the policies that are being advocated for blacks in the United States have lifted any people out of poverty. I've seen many examples around the world of people who began in poverty and ended in affluence. Not one of them has followed any pattern at all like what is being advocated for blacks in the United States. Many groups have remained in poverty for a very long time, trying to follow those patterns.
These sort of permanent indigent classes.
That's right. Within the blacks, there's a very diverse movement, though. On the one hand, you have blacks who are getting more education, who are going to college, and so on. Their incomes are rising, not only absolutely, but relative to that of whites of the same description. It's those blacks who have not had, say, 9 years of schooling, who have not had 6 years of experience in the job market. Their incomes are declining relative to the incomes of incomes of whites. If over the very same span of time, so it can't be a matter of the business cycle or something like that, is that those blacks who have the advantages relative to others have now still more advantages. But those who had the very difficult poverty to deal with, that is becoming more difficult. A higher percentage of all black income is going to the top 20% of blacks over time.
Well, do I understand you to say that the government has exacerbated the plight of these poor blacks?
Yes.
How?
A number of ways. One, they've made it difficult to get jobs, to get started in the job market. Minimum wage law would be one of those things, but only one. The terrible schooling would be a major factor. That if you're going to turn out kids who are 40% functionally illiterate upon graduation from high school, then you're going to have very serious problems in the job market.
And the government is responsible for that?
The government
Through
runs
the
the
public
schools. Yes. State as well as federal. They're doing many things to make it much tougher for the person at the bottom to get started And they're also making it less necessary to get started by having various subsidy programs, food stamps, welfare, and so on, which reduce the difference between working and not working. So that the general tendency of what they're doing is to make it harder to rise. But of course, if you're lucky enough to have started to rise before these programs began, then you're in great shape.
So Dr. Soul would argue the causes for the economic challenges this group has faced in the past, and I'm not going to mention the group because I don't want this video to be banned by YouTube, but the causes are far different than what you would be led to believe by watching the mainstream media. Number one, it would be the minimum wage. This decreases job opportunities. Number two, poor education reduces the marketable skills for the group as a whole. Now, I want to point out, maybe some of you there would say, okay, well, this is why college should be free. But he points out that it's bad education. It's not the lack of education. And just because college is free doesn't mean that it's a quality education. In fact, I would argue you get what you pay for. So if college is free, that's exactly how much that diploma is worth in the job market. And he also points out one of the main reasons that this group has faced challenges is because of the welfare system. This creates the incentives that makes the delta between actually working and not working almost insignificant. He also points out the wealth has accrued to those few individuals at the top that weren't caught up in this net of bad policies set forth by the central planners and the do-gooders. It goes back to that old saying, the road to hell is paved with good intentions. And one crucial key I want to point out that Dr. Soul found in his years, decades of research on these topics is that the policies, especially welfare, have never worked for any group in any country, meaning that welfare and government policies have never lifted a group out of poverty. In fact, more times than not, they keep that group trapped in a cycle of poverty. So if Dr. Soul is correct that these policies led to the economic challenges faced by this particular group in the United States, shouldn't we assume that the exact same policies prescribed to the entire population of the United States will create an environment where not just one group is economically challenged, but society as a whole? I know the push for equality is extremely popular right now, but if we continue down this path, if we pursue these economic policies, we will be equal. But like Margaret Thatcher said, we will all be equally poor. And like I said at the beginning of step 3, I know all of this is controversial. I get it. Most people on YouTube wouldn't touch it with a 10-foot pole for obvious reasons right now with the whole narrative of social justice and the PC police monitoring everything. But I'm always going to tell you what I think you need to hear and not what you want to hear. Hopefully all of you watching this video can appreciate that. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.